welcome to all of you on this webinar. The topic is something that a lot of people have been coming to on in the last few weeks and probably last few days. So I said, okay, let's actually have a webinar which actually addresses this and gives our perspective. The US markets have been pretty weak. In fact, I think the number that I gave of 25% is not necessarily true when it comes to the NASDAQ, because the NASDAQ has fallen a staggering 34%, right? And so what we've captured here is the market falls for each of these indices, okay, from their respective peaks. So which is why the dates may be different for each of them. For example, the S&P peak was in Jan 22, whereas NASDAQ started falling right from, say, November of 21, right? So, so it's been reasonable carnage that you're seeing, especially in a lot of the technology stocks, right? And I guess if any of us have ESOPs on those, US technology stocks, unfortunately, they are not going to look good for us. So that's something that we will also we could discuss, in the Q&A session as well if we have any queries out there. Indian markets have been far better off. The Nifty is sort of down in less than 10% from its peak, which is sort of very good news. Interestingly, the mid cap has fallen lesser, while the small cap has fallen more, right? So it's a clear situation where the one in the middle has fallen lesser, and the two sides are the extremes. Of course, small cap stocks have really, fallen, at least 50% higher than the Nifty. So that is something that is the tone, so the big question mark, I guess, in all of our minds is, will the left side start looking like the right side, right? So that's something that we'll try and address today. So stepping back into sort of what are the factors that drove the fall, right? The trigger in some form was the Russia-Ukraine war, but the actual impact that it had was on inflation, and you can see the table on the left-hand side, crazy figures, and I don't remember the last time that India had lower inflation than the US. And look at the UK, 9.9%, Germany 10%, Eurozone 10%. So some of them are really struggling, thanks to their dependence on Russian oil and also a lot of other commodities from Ukraine, etc. So that is something which sort of triggered this whole market cycle. And what actually spooked markets was, the interest rate spikes that happened, right? So, and let me sort of step back and give you a background as to why this is important, right? If you go back and look at one of the key reasons for the US doing extremely well, right, was the interest rates were maintained very, very low. And when interest rates are maintained low, people don't have incentive to actually keep money in deposits. They will want to go and put it into equity markets and stuff. The second thing is also loans come by, so consumption and come by at lower interest rates, so consumption is much, much higher, especially in economies like the US, which have where individuals takes reasonable leverage compared to, let's say, what is the case for India. So that sort of creates growth in the economy, and when there's growth in the economy, there's growth in earnings, and accordingly, the markets also do well. Now, the concern that markets have is that when interest rates go up, the counter also should happen, right? So if the US benefited from lower interest rates and it saw a huge boom for almost like 13 years, okay, will higher interest rates actually create, a down, and that has been the big concern. The Fed has been very aggressive, and all central banks have been very aggressive. If you see what the chart tries to convey is the steepness of the curve, the current one in 2022. It's not the highest, okay, it's about 2.36% is what they have actually increased interest rates. but it is the steepest compared to every time in the past. Okay, and I will possibly, get towards what is sort of an average. I would think that, closer to 3%, plus or minus, is what one thinks that it will sort of end. But there's definitely, cause of concern for the US economy, and markets being a leading indicator, pricing in that the US is going to face difficulty as we go forward. And obviously, then what about other countries? They say, like, there is a impact, when the US sneezes, the rest of the world catches a cold. So that is something which is a big concern, that and everybody globally also have globally markets have sort of fallen. Yeah, and just a quick one on the rate hikes, both in the US and Europe. You will find that the ECB has been slightly slower. Of course, we look at it in terms of what is the policy rate that the market prices in, with a sort of a 1 year forward rate, and that if you see, it's been almost forward looking. So you'll find that the rates there have already gone up, and market is expecting higher interest rates, which is why, say, the dotted line versus the line, which is the market rate, is the line is higher than the dotted one. Okay. So the other is I just got a message that people are able to see my screen. Hope you are able to. Can somebody, Sanjay, can you confirm?
Yes.
Yeah. Okay. Thank you. Yeah. So the present scenario, of course, is if we look at it from a very long period of time, it unfortunately comes to really extreme levels. So if you see that both in terms of oil shock and the energy prices, as well as food, right? We are at almost like all-time highs. If we set aside, say, the 72 to 74, 74 type of 1974 type of period out there. So that is something which definitely is a bit of a concern. And while and on the right hand side, if you see this the sequence of events that normally happens: geopolitical uncertainties, supply shortages. I think we saw both of them. Okay, and so you see commodity price increases, inflation increases, as well as you'll find interest rate hikes happen, and typically the economy enters into a recessionary phase. Now that's something that I guess is on the minds of all of us. Do we think our economy is entering into the recessionary phase, right? So I want to keep this a little interactive, and I have a few polls. So the first one, I'll request Sanjay to run a poll. Okay, on, do you think we are headed for a global recession? Yeah, so thank you for the wonderful participation. Okay, there's a thumping yes. Okay, I'll just give, yeah. We can share. Yes. Okay, so this is what we have. We have almost like 75% of the participants feeling that yes, we are headed for a global recession. So that's, I think there's a very, very clear mandate out from people who attended, right? Yeah. Thank you. So the second, yes, I will share the results. Yeah. Okay, thank you. So actually, if we look at it, technically the US is already in a recession. Okay, so what is the definition that people use? It's basically when you see two consecutive declines in quarterly real GDP growth numbers. Okay, then a country is said to be in recession. The same happened if you saw in COVID time. There were 2 quarters, and of course those were pretty large ones, and we are seeing it again. The good news in some form is, you see, the numbers are reasonably muted on the downside. It's not some really crazy numbers on the lower side. So that's one sort of good news. The second is there are still debates on, because see, one is what is a technical term, right, and the other which is on the ground. So if you're on the ground and you see you say you're in a recession, then things are tight. Jobs are hard to come by, and probably we're seeing a lot of job losses. Consumption is low, so various factors out there. Okay, and there's a whole tightness in the economy. Now, even in the US, and that's what's also spiking up inflation and interest rates, and the central banks are reacting and increasing interest rates, is that the job market in the US is reasonably strong, right? So, and if they have to sort of bring down inflation, central banks would like it's sad, okay, and that you want to see not such a strong job market, okay, but when consumption is high and salaries are high and coming by, then it only fuels further inflation. And there's a social side to it, which is why central banks are also sort of prodded by governments to ensure that inflation is under control, right? So that is something which so the issue that you face is when you try to and the central banks try to sort of bring down inflation, it impacts markets, it impacts the economy, and that sort of is why many times markets react negatively. The other question that, and it's an interesting one, if you see the Nifty and NASDAQ with some deviations were sort of up to Feb or March of 22 was sort of in sync, right? Initially in October to December of 21, there was a bit of a divergence where Indian markets didn't fall, for some time, okay, and subsequently, of course, it fell with a lag, and it probably fell as much as the markets for a period of time. But then one found that the divergence started from March of 22, and the Nifty is the red line, actually did far better than the NASDAQ, and we've seen that in the numbers as well. So and there are various reasons for it, FI outflows, crude prices, etc., etc. So that brings me to the next question, okay, on the poll. Can India decouple from developed markets? Sanjay, can you bring up the poll, please?
Yes, sir.
Yeah. I think, again, there's a reasonable majority in terms of saying that no, India cannot decouple from developed markets. Okay, we'll just give a few seconds and end the poll. Okay, and so it's interesting, almost like 61% of the people feel that India cannot decouple from developed markets. Okay, on this particular one, I will hold my point of view as I progress in the presentation, and probably at the end I will be very specific in terms of my views on will India decouple or not from developed markets. So I would like to spend some time on what we think are the reasons that in the long term, India is likely to do very, very well. Okay, and one of the few aspects, and one of the key aspects actually, is our demographics. We have a very low age, median age of, I think, somewhere around 28, 29. Okay, and if you go back and look at whenever you have a low median age in the past across other countries, and the US especially saw a huge baby boomers phase, when it basically means when the median age is low, a lot of people who are actually below the working age who come into the working age of the population. So the inflection point that we've seen is somewhere around 30 years median age, and then US saw almost like a 2-decade secular bull run in their markets, because consumption increases and stuff. The second part of it is also how consumption increases as the per capita increases. Now, when you find that the economy grows and the GDP grows and the per capita income grows, which has been true for India, and as we think that higher towards the 3,000 levels and 5,000 levels, etc., okay, one will see that from various sectors start to participate in it. Okay, and you will find that the banking penetration, the retail, of course, India, I think, is very good on the retail side. The real estate, the mobility in terms of including, how many cars, for the average 1,000 of the population, people, have cars out there. So all of them, sort of will keep on fueling you to sort of higher thing. And the example of the US is sort of what we've given on how, consumption sort of increases, and possibly that was the reason why sort of the US sort of saw a very large, and secular bull run post that. So we think that one of the key factors where, from a long-term perspective, India is likely to do well, is thing. The second is our earnings growth is likely to be very strong. So you will see that India actually had a very flattish earning growth, though this whole 2011 to 22, if you see, 2011 to 20, right? So from 315 to 472, right? So that was the EPS of the Nifty. So that has been, how it is. And you see that for periods, and if you go back and study the cycles again, 97 to 02, that was even more flatter, right? So we saw a bit of a spike happen between, 2003 to 2008, which is why we saw a huge bull run out there. Now, the second expectation also was, this is a chart that, we actually had captured in the past as well, which is why we said that we think that India will do pretty well in the years to come. And that view sort of continues in the long term. I think, there's going to be a spike, and you see a real, almost like a 26% compounded growth rate between 20 and 22 is what is the expectation. Of course, it may be slightly higher because a little bit of the low base effect thanks to COVID, but broadly, you will see that even if you ignore that COVID year, the growth in, there's a spike in the graph that you can see here. Okay, so the other point that I would like to make, and why India is a little different from the other. So my point is, in itself, India has a lot of fundamental reasons which sort of, will help it to do well, will help companies to do well, the economy to do well enough, and as a consequence, the markets as well. And one of the things that we should keep in mind is, actually, if you see the right-hand side, right? So for India, actually, despite the spike in interest rates, we are lower than 2014. Okay, so the inflation is lower than 2014, right? So that is something that one keeps in mind. Whereas if you look at for countries like the US, it's whole significant change. From levels of 2 to 2.5, 3%, they've gone to levels of 8% plus. Whereas for India, from levels of say 2014, inflation was say 12%. It is now sort of closer to 8. So that is something that we keep in mind. And the left-hand chart also brings that out, that for the US, inflation is at a 40-year high. In the UK, it's at a 30-year high, right? So whereas for India, it's sort of come back to us, 8 years. So that is something that, we sort of keep in mind, that inflation in India, even though it is spiked up, we are in a far better place. And it is unlikely, therefore, that interest rates also go higher than the previous levels. Okay, so that is something that's a view that sort of we are taking, that and we think somewhere from here, inflation also should start coming down, and the pressure on interest rates also should come down. But the point I'm making is, for the US, when it comes down, it's likely to be higher than the past, right? So it means that interest rates going forward, even after inflation comes down, is likely to be higher than the levels that they saw in the past few decades. Okay, whereas what we are saying is, for India, we believe that the trend is toward lower interest rates, and that is beneficial for the economy. And we just gave the example of the US, which benefited significantly from lower interest rates and lower inflation. Now, there are a few other factors why we think India's, in fact, I've been saying, and it's been our view that right from sort of even the later part of the last decade, that we think that India is going to be the country of this decade. And the economy is going to do very well, and markets also are going to do very well. That sort of continues. And we think that there are other factors, from the ones that one called out in the charts, which are the current factors, but the longer term ones also are there. India is going to benefit from global factors, the move, from MNCs and countries to de-risk from China and say, even if we have manufacturing bases, we want China +1. We want an alternate base to China as well, even if the cost is higher, more from a risk mitigation standpoint, right? So the other one is about, like Ukraine again. There's disruptions on gas and oil, and some of the factories have sort of closed down because of shortages of gas, and India will benefit from some of that because the capacities and this is not only about Ukraine, it's about the whole of Europe, right? So so a lot of the manufacturing facilities in Europe sort of are at lower capacity or closed down. There are high fuel prices, shortages of essential commodities and stuff. So that is something that has been a bit of a benefit to India. And of course, now the new theme has come on a Europe +1. Okay, so the things are sort of changing out there. I think at hindsight, the Make in India campaign was very, very timely because now you can see when actually China +1, Europe +1, etc. come into place. I think there already is a visibility branding, and companies start looking at India for their manufacturing bases. And I think that is a clear trend that we are seeing, and we think that manufacturing will do very well for India. We also have seen a lot of developments, a lot of reforms. I think if you are going on you're traveling across cities in rural areas, etc., you'll find the roads are far better than what they used to be in the past. The whole GST, the access to banking, UPI, the mobile penetration, and also something very fundamental like the education levels, even in rural India, has sort of significantly increased from sort of the past. And we think that all of these have sort of a very long-term beneficial impact. And the last is, I think there's going to be a spike in growth from entrepreneurship and startups, because I think that whole ecosystem has come up. Today, Indian entrepreneurs are willing to sort of stand up and say, okay, I can compete globally and I can win. Okay, so they're not anymore, sort of having their sides small. Okay, and that also has seen a lot of money come in thanks to the growth in the Indian economy, the consumption, etc., has also seen money coming in, and that also has fueled it. Entrepreneurs also have got exits in their businesses, large exits in their businesses, and a lot of that money is sort of come back again to fuel for the startups of their own or others. So I think that so I'm just saying that the long term, before I come back to the point on do we think it will decouple or not, I thought let's look at the long term. The other part that and the reason I think why Indian markets have not fallen as much, right, is because while the FIIs have sold in large quantity, you can see that 3.9 lakh crores, okay, is what they have sold in between October 21 to July 22, right? And there's been almost like 3.07 lakh crore infusion from domestic institutions. So two things, it means that I think the whole market has sort of become more stable and the domestic infusion is there, one believes that the domestic infusion into markets will continue because one of it is coming from SIPs. We have in excess of say $1.5 billion being invested in SIPs every month. Okay, so those are the staggering figures that is coming from domestic investors, and we believe they are more sticky. They are unlikely to sort of just overnight move the opposite direction because they are systematic investments and they're not one-time investments, right? So one-time investments typically, when markets fall, they fly the other side and move out. Okay, but SIPs, we think the value of SIPs may come down, say to 1.25 billion or 1 billion, but one doesn't think that sort of it will completely stop and go negative. So the other thing is certain structural reforms that came in on the employee provident fund side, and so the EPFO increased the percentage of investment into equities, and since then there's a very strong flow which is happening into equity markets from the EPFO, and again this is going to be even more stable in our view than say the SIPs, because as people are earning, money goes into the EPF and part of that comes back into markets. So that's something which we believe will sort of there to stay. That said and done, I think before, again, these are charts that we captured in the last time, and I said this was my concern. It actually unfolded in the same way. Our point was, the left side of the chart was, when we had the webinar, I said, yes, we just sort of are at breakdown levels from the moving average, and my question was whether history will repeat, and it goes down into one further wave down. Okay, so that has happened. Now you would see that even when these waves down happen on the right hand side, there are pullbacks, and I would expect pullbacks also to happen, and that pullbacks can be large, and even in the US, but for countries like India where we've seen which are much stronger, probably the pullback also can be larger. So our point is, in the short term, I think we have to, the risk is also on the upside at times, because everything goes negative and we think that markets will sort of fall, and the opposite happens, right? That brings me back to the last poll, okay, because this is also linked to the rupee, and a lot of NRIs have been coming and asking me, over the next 12 months, do you think that the rupee will appreciate, depreciate, or remain flat? Yeah, so this is an interesting one. It's almost tied between remain flat and depreciated. Okay, so let me end the poll. Yeah, so there are very few people who believe it will appreciate. Okay, so and the expectation that it will depreciate and remain flat. Okay, and let me share my perspective. Whenever I've spoken to NRIs, they only remember that the rupee depreciates. Okay, so this is something which somehow, at times we see certain sides to it. Yes, in the long term, say the rupee has gone from 45 to 80. Okay, but if I look back at it, every time there's a large market fall, there is global economic volatility, right? You will find that the blue line is when it's a very sharp one, if you see. Okay, that is when the rupee is depreciating. Okay, so if you see the 2008 to 2009, there's a very sharp depreciation in the rupee from, I think, somewhere around 42 levels, 43 levels to about 50 plus. Okay, similarly, you found that in 2011 there was a sharp move, and that moved from almost like 45 levels to probably above 55 levels. Okay, there was one more move that happened subsequently in 2013, of course. So the point that I'm making is, if you see, whenever there are periods of global market volatility and there are sort of question marks in, actually, if you move this chart, and I would have ideally wanted to have a 2001 period as well. And if you saw the 2001, exactly the same thing happened. While that dot-com bust happened, you found that the rupee sharply appreciated. In fact, that it went up to 50 levels again from 35 probably, and then it sort of came down, remained flat and stuff. So the point I'm making is, data has shown that wherever there's a large spike, okay, you find there are periods where the rupee subsequently actually appreciates. So we are taking a contrarian call here again, and the point of view is that yes, in the short term, one believes that till there's global market volatility, which is why from 82 I put a question mark. I'm saying that I don't know where it will go. The levels that it can go to, in our view, based on the technical analysis that we look at, is anywhere between 85 to 88 levels. Okay, but my point is subsequently there are long periods of rupee, actually being flat or depreciating appreciating post that. Okay, so one believes that there will be a multi-year period where the rupee will appreciate. Okay, and that we think, from within 6 months or so, we should start seeing, the rupee actually appreciating. So our point of view, on a 1 year basis, we expect the rupee to actually appreciate, and this is a bit of a contrarian call from our side. Okay, now so I'm coming back again on, we all think, oh, recession is bad, and the markets will fall and stuff like that. Okay, what is very interesting, if you see here, is the falls are not very long. Okay, because we believe that fear is what creates some of these falls, and fear is a stronger emotion, and so the falls are very sharp, and because the falls are very sharp as well, the bottoming out also happens much faster. So if you see, in each of these falls, we've not seen a period larger than 15 months. So typically, there may be some extremes that happened around COVID, for the reasons we all know. Okay, but in most other cases, and that's even shorter. That's the point. The fall was even shorter. But on an average, 9 to 15 months is what we think that markets tend to bottom out. I may give it another 3 months. So I would believe that an extreme for sort of this market down will be by March of 2023, right? And this a lot of people have come back to me saying that they expect a longer recession. Yes, I expect a longer recession for the US. Okay, the question is, does that reflect in the global market charts? The good news is markets discount the future much quicker than the recession actually ends. So at the peak of recession, you'll probably find the market start going up, and so that's the whole point, where markets tempt you to do the opposite of what you should be doing. And I got a number of calls in the last week, in fact, last few days as well, saying that we think recession is there, even including clients we had already booked profits for. They said, no, I think recession is coming, so we should do a much larger profit booking, take some additional money out. And our view is markets are two things. One is that the what is on the ground, what is the economy doing, number one. Secondly, what is the anticipation that happens, and third is the sentiment. Okay, so the anticipation of, say, market growth or the economy, the last is being sentiment. And what we've seen time and again, wherever the sentiment is at an extreme negative or extreme positive, markets tend to reverse from there. Okay, and interestingly, on, let's say, our portfolios, we just went and deployed a little money in the last week back, which we had sort of increased a little bit of cash on our portfolios. We went and deployed some of that back over the last week, because we felt that the global sentiment as well as the sentiment in India was so negative. And I have it's also an indicator for me that when a lot of people come to me and a little tense and worried, I think that bottoming of the market is close by, because that's another sentiment indicator. But there are, of course, there are other ones, and number-based indicators that we have, which also measure sentiment, and that's what because I track numbers, and I think because numbers don't lie, okay, and one tracks the cycles and trends in them. So from periods of extreme itself, before waiting for markets to actually go up, one takes actions on them. So this is sort of my point of view. In fact, I won't be surprised if we see from here a much stronger rally than most people are expecting. Okay, even in the short term, even if the view is that there should be another market cycle down. So I'm just saying that. So coming back to the point of, do we think India is going to decouple? I'm saying in the long term, each economy does its own thing, right, based on underlying factors. So the last decade, while the rest of the world was doing badly, US did extremely well. Okay, so that's an example, and we'd have found in the previous decade, say China did very well, right? So countries based on underlying factors have long-term established trends, and we believe that long-term established trends is in favor of India. That's number one. Okay, so we think in the long term, it's not about coupling or decoupling. It's just that the economy is likely to do better for various underlying factors that I have outlined. So one has a very strong positive view that India is going to be the country of this decade, and we are going to do extremely well both on the economy as well as on markets. Okay, but in the short term, it's my view as well, when there is fear, at its extreme, there's no decoupling, right? So I concur with the view that there may not be decoupling, okay, at points of extreme, but in these rallies, like you've seen the chart itself of how India versus, let's say, NASDAQ has performed in the recent time, and then the decoupling that we can already see in smaller phases, right? That may be there. So the view is that India is unlikely to decouple if we see a next and the last, what we believe is the last leg of market fall, in the US. But before that, we may just see large gains. So I would rather take that and then de-risk from there. And the second part is, you never know is the downturn over, because if I go back and look at it, NASDAQ falling 35%, okay, is a reasonably large fall, right? It could have, if I go based on past cycles, that 35 can possibly go to 60%. That's really bad news. In fact, that is the view, okay, that we think that's a risk that we see for NASDAQ and technology companies. So our view is that anybody who's looking at or has resources in technology companies, I think needs to continue to de-risk from them. And if they get some opportunity and the market sort of sees a little bit of spike that we are expecting, I think those are times to take some money off the table. Okay, but so the point I'm making, just to summarize, I think in the extreme short term, markets are at a sentiment low, which is why there should be a bit of a spike from current levels and possibly go up. That's the first point. The second, and the slightly medium term, over 6 months, the view is India is not likely to decouple, and if there's a next leg of fall in the NASDAQ and US markets, India will participate in that on the downside. Okay, so that is so I'm saying tighten your seatbelts for that type of situation. But in the long term, and which is why this time we are not going as conservatively in our profit booking. In 2007, October, November, we booked and moved out 50% of equity to debt. And that was a recommendation. This time we did 15%. Okay, and that was done before. So we sort of took advantage of the current market volatility. Okay, including on our portfolios. So I'm very happy that our PMSs as well tend to do extremely well relative to the market in periods of extreme volatility. in line with our philosophy of managing risk, and it shows up in numbers as well. So that is something that we will continue to want to whatever we talk, we'll want people to see in numbers. Okay, so that is the point that I'm making. But in the long term, and this is the chart where I'm saying it's too risky, okay, to get into too much of cash, because our valuations are very, very attractive. Okay, so if I look at this particular chart, okay, the red line is the Nifty PE ratio. The P ratio is a measure of valuation. It means that how highly valued is the Nifty. Okay, so which means that it's basically, it divides the Nifty by the earnings per share. Okay, so you'll find that interestingly, even while the Nifty went up, okay, from about, I think, April of 21, one found that the P ratio started falling, and the reason is the earnings growth was very, very strong, which is the denominator of the P ratio, price by earnings, right? So because the denominator went up very sharply, faster than the Nifty, you found that the P ratio fell sharply. And interestingly, the period that we've seen this valuations was in COVID. So you can imagine, at a market high, we are at valuations closer to COVID, okay, the COVID lows. And the only time that we've seen it, okay, there's been one period around 2016, but before that, the PE was in this range only in 2014, which means our valuations are at almost like an 8-year low. Okay, so that is something that one is making a point that it's too dangerous to be in cash, because if markets suddenly move up, because it's a simple thing, earnings growth will reflect in equity market growth. Okay, that is the highest correlation in the long term. In the short term, they may diverge, but in the long term, you'll always find that the earnings growth, in the end, result in market growth and stock price growth. Okay, so that is something that we believe that we should not be getting into too much of cash. So when clients came to me and said, okay, let's do one more level of profit booking, my point of view was that it's not what I recommend. Okay, I'll probably wait for some time. And if you still want to de-risk, in this rally, possibly we can take some more money off the table. But I think right now is not the time to sort of de-risk further. And the other point I'm making is, which is the chart, the table at the right. Okay, this basically means that what is the market falls? Drawdown means falls from the peak, right? In 2000, market fell. 2001, market fell 51% from the peak. Okay, but before the fall started, what was the P ratio, right? At the peak, the P ratio was 28. Okay, so before the fall, and then market fell 51%. So if you go back and see, closer to the current levels of 20, right? In the past, we've seen only a 15% market fall. 21, 22, yes, we've seen a 30% fall. So I think at extreme, I would believe that we can see up to a 30% market fall if global markets also fall. And like I said, I don't expect India to decouple, okay, in such a fall. And so that is the potential downside that we see on markets. But my point is, if many times it's very difficult to get the exact bottom, okay, and if you miss it, like what we've seen, immediately after COVID, somebody missed buying in, immediately around COVID time, markets went up so much, right, that it became too risky for somebody to enter. So market just flew away, and we believe that at some point of time, markets will fly away on the upside, and which is why I'm just saying that in the short term as well, we are not suggesting that you take very large cash calls. I mean, a little bit playing around to manage risk is something that one can do. But today, the risk of the markets, despite recession and despite all the fears, we believe the risk of the market is lower because of valuations are very low. And at the bottom of this chart, actually, you have a table where we said if Nifty, the P ratio, for example, is less than 22, typically the index has given a 3-year performance of 62%. which means it's gone up 100 rupees or gone up to 162 rupees. Of course, it's not compounded; it's a cumulative basis, and you'll find that which is in excess of 20%. And if you see on the others, it's 16 to 18%, which is 5 to 6% per annum. That's it. If the P ratios are higher. So I'm just saying, from a long-term basis, and if you want to look to accumulate your wealth, tighten your seat belts and possibly ride the wave. Okay, and interestingly, we called out that we thought India is going to be the country of the decade. Actually, somebody felt that country is going to be the country of the century, right? So there are a lot of positive news that have come. Even the MD of IMF, for example, has said India deserves to be called a bright spot on this otherwise dark horizon. Okay, so that is something which it is there, and very, very well-known individuals have come back and given some very positive views of the Indian economy, and we think that that is something fundamental and will sort of only do better. So in summary, I wanted to keep some bit of time for question and answers. Okay, so what are we saying? Technically, US is already in a recession. So the question is, are we going to be in a recession? Actually, at least US already is. Okay, I think we continue to have a negative long-term view of the US economy for the reasons that I've already stated. And unfortunately, or the bad news for them is that, or what I think is the bad news for them is that we believe the next 2 decades are going to be decades of pain for the US. Okay, and the reason for that is we believe that after a real good decade, a good period, of economic expansion, okay, you find that liquidity becomes tighter. Okay, you'll probably see some bit of what we call as deleveraging. Okay, which means that loans will be difficult to come by, NPAs will go up, and all of this we've seen in the previous decade. So we're actually out of it, and so we probably see the positive side of it, with write backs that come in from the NPAs of the past. So that is something. We are not ruling out one more leg down for the Nasdaq. Okay, and like I'm saying, in that period, I don't think India will decouple. Indian markets can be volatile if that next leg happens. Okay, but my point is, at the current point of time, a bounce in a bear market can be large, and we believe that a bounce is sort of imminent because of the sentiment indicators being pretty low and pretty negative. So I'm saying tighten your seatbelts if you see short-term volatility, but don't worry. Okay, if you're able to manage it, you can also help it. You can use it to enhance returns. We like to do that. Out there, and we are comfortable with current market valuations of around 20, and any further fall will make Indian markets very attractive. And we think that FIIs also will come in. So you can imagine, if both FIIs and domestic institutions together invest, other markets are just going to, fly away. And like I said, in the long term, it may just look like a blip. We saw the periods when, there were large market falls. I'll just, maybe refresh you back, come back to that, just to calm your nerves a little bit. Okay, is every time there's a fall, so and some of those falls are like 50%, and large falls that we have seen, okay, 60%, etc. And those, large falls, when you see them, after a period of time, they just look like a small blip. Okay, so while we try to manage risk, I think we need to get the longer term trend in, because at times if you just miss one move, the rally may be over. Okay, so that's all from my side, and I've been itching to have this quote back. Okay, we had different quotations, and the quote of Warren Buffett, which says, "Be fearful when others are greedy, and greedy when others are fearful." Yes, so thank you. And Sanjay, we can take up questions.
Yeah, Thank you so much, sir. I will just read out the question. So the first query which we have from Mr. Hers, when FII will stop selling and start again investing in Indian markets?
When will they start? So actually, if you go back and see, FIs have sort of significantly the selling pressure reduced. In fact, there was a period when it was positive as well. But when again the US saw some volatility, and some of these you must understand is triggered by their underlying investors. So individuals in mutual funds and other PMSs and other securities in the US, seeing markets volatile, take money out of it. Okay, so and then they are forced to sort of take money from the underlying fund, and if that's an emerging market fund, they take money out of it again. So so that is something which is there. So I believe already FIs have significantly reduced their selling and have become a lot more bullish than that what they were in the past. But it's more that their investors have been pulling out money, and so those flows are forcing them to exit their funds in India. And I believe that this will completely turn to the positive once we see the low of the market. Okay, so again, when there's volatility, you may see one more level of a little bit of negative flows on FIs. I don't expect it to be large like what we saw in the previous period. Right. So I would think from after 6 months, anywhere between 3 to 6 months, I expect FIs to come back and start investing into India in a larger way.
Thank you, sir. The next query is it better to invest in a small cap and mid cap, or now, or large cap is better?
Yeah. So typically, we believe that there's a cycle that between large cap and mid caps. Okay, and that is something that we look at. What we call as relative valuations and relative performance metrics of the mid cap versus large cap index, and from that basis, just to step back and just give you a bit of a perspective. Okay, in 2017 we moved out of mid caps into large caps. Then mid caps really fell off while large caps did well in that period. Okay? Subsequently, from 2019, we sort of increased, our mid caps. So right now we're in a period where, and each of those periods when we did our switches, we were concerned about valuations. Like in 2017, we were concerned about valuations on mid caps. And 2019 we were concerned of valuations on large caps. Okay, so which is why we took whatever steps that we took to do some of the switches. Okay, but here actually the first thing I'm making is a difference this time. We are not concerned on valuations of either. So it's possible that I think both may sort of do somewhat better. So I would do a combination of both. Okay, so at the same time, I think when that initial wave that, let's say, FIs invest, because of their size of investments, okay, and the value of investments, they are not able to invest in mid and small caps. At least small caps they cannot invest. Some of the larger mid caps they may be able to invest. Okay, so I'm just saying that. So there could be a bit of an impetus when large caps may do marginally better, but I don't think it will be really significantly better than mid caps. Okay, but yes, so I would say a slightly larger bias towards large cap, but I would, it's not a, very, very high proportion of, large caps that I would suggest right
now. Thank you, sir. The next question is more on what are your views on IT and financial sector? Are you bullish more on domestic sectors like staples and consumer discretionary? How will income inequality decrease in inflationary time, and hence how will consumption broaden in India?
Yeah, so IT, unfortunately, we are slightly negative, and that has to do a little bit with the underlying market, we are saying that US is likely to do bad. Okay, so this is a slightly longer term view. In the short term, we are going to benefit from, IT is going to benefit from a depreciating rupee, which is why you will see these, pullbacks. And these are good times, in my view, if you have IT stocks, ESOPs, etc., to sort of book some profits and diversify. Okay, so that is one clear point of view. And of course, if it is, and that if it's a Nasdaq stock or then and global stock, then there's even a higher reason why you should do that. So that's the first point. Financials, in our view, are likely to continue to do well as the economy sort of broadly does well. So that we think we have a bit of a positive bias around there. Yes, on domestic versus export oriented like IT, pharma, etc. Right now, we believe that domestic is likely to do better. By domestic, I'm saying manufacturing, and today, and some of the other sectors. And interestingly, they are also becoming a little export oriented. Okay, so I would like to also mention that our typical the earlier way we used to look at it, saying that okay, manufacturing is domestic, may not stay as much. Okay, but I'm just saying the core sectors like manufacturing and all of it, I think should do better, and that could also be propelled by a little bit of exports from these traditional sectors.
Thank you, sir. The next question is value investing enough, or should we combine value investing with a bit of price action and techno value analysis to stay profitable in both short term and long term?
Yes, so see, I think you get into a little bit of techno, etc. If one has the time, energy, and is able to track markets, I use a combination of all factors. In fact, there are different styles that we have even within our PMS. The style that I like is a little bit oriented towards growth, but growth, when we look at growth, we look at it at a value. Okay, so it should, it doesn't mean that whatever the value, valuations are high, I would still invest in a growth stock. So I would look at a growth stock where the valuation metrics are reasonable. Okay, so that's how sort of I would prefer. And yes, for turning points and stuff like that, I also do watch technicals, and I also follow a few people, and that sort of also helps me sort of get a broader point of view, and see any red flags that I think are going to come out in markets, because some of those direction changes, actually my first trigger comes from the technical side. Okay, and of course there are different forms of doing it. There are some people who do it after confirmation. There's some who do in a slightly contrarian type of thing, when you look at extreme readings and not wait for the breakout or the breakdown to actually happen. I prefer to sort of use that style a little more, but yes, there's some bit of complexity that markets do bring.
Thank you, sir. The next question is, what is RH's approach to global funds, hold or exit?
Yes, so we have been very negative on technology, and for some period of time, because like I said, we had taken a contrarian call on US, and interestingly, we took a contrarian call on Nasdaq, especially to the extent that a few customers were not happy with my point of view. Okay, because a lot of them are from the technology side, and they saw things doing very well, and they said the question they asked me was, why would you think that technology will do badly? Right? Because after COVID, etc., isn't technology, a necessity? It's no more a privilege, right? So my point, yes, there's a difference between markets and what you see on the ground, and because markets is about growth in earnings, okay, whereas the product may continue to grow, but earnings may not. Okay, so and that's something that happened, is what one was expecting. In fact, at hindsight, COVID actually pulled in a few of maybe growth earlier. What we should have seen 2 years later, we probably saw 2 years earlier in terms of growth in penetration of technology. So and from there, once you have full penetration of technology, then growing from there becomes a lot more difficult. And I give this example always of the Indian technology services companies. Like I remember Infosys was growing at over 100% per annum. Okay, and probably even 140% per annum type of growth, etc. But then at one of their earnings, they came back and said, next year we are going to grow only at 35%. And markets fell, something like at least I think Infi fell almost like 60-70% from there. It never made losses. It grew faster than most other sectors in other companies, because 35%, etc. was good growth. Okay, but you ended up seeing the stock price come down. So that's the point. So my just to come back to your query, we have been negative on global. We are much more positive on India right now. If I see relative to other markets, I may think there are bright spots, say, in Vietnam and some of those ones, say, which may benefit from China plus one type of thing. Okay, but I'm not as bullish of, especially the US. Europe has been in ups and downs, so at some point of time it will also bottom out, and sort of you may see a little bit of growth coming back there. But right now they're in a huge mess, with disruptions thanks to Ukraine. So I would believe that, and of course China is already seeing the second decade of down, okay, in line with our expectations, and they have a lot of fundamental issues to solve. The NPAs are very high. Okay, some of the real estate companies have been defaulting. Okay, and we think that there's a lot more, issues that at a fundamental level, internal in their country, that China is going to see. So we don't expect that to happen. Russia, so all the BRICS countries, for example, have their own issues, and India looks like one of the few brighter spots out there. So I would look at India focused. I don't mind looking at global to diversify, but I would that global one needs to be well diversified and not just the US.
Thank you, sir. The next question is, what level we should start worrying for the level of crude plus rupee will go down to what level?
So like I said, I expect the rupee to go down to, up to 85 to 88 is what we are seeing on our technical charts. Okay, from there, I believe that rupee will significantly appreciate for maybe 3 to 4 years.
Thank you, sir. The next query is, do you think our government along with RBI are proactive and doing right things?
Yes, I think different people have different points of view. Okay, so I believe and I would restrict my view to the economic side of it, and I think they've done the right thing on the economic side. I also think they've done the right thing on the foreign policy side. Okay, so I think the way they handled imports of oil from Russia very well sidestepped. Yes, there will be negative implications that with the US on that. Okay, but they did a very good job of ensuring that we don't get into a situation like the European countries, right? And see some huge disruptions on oil, etc. And we benefit from getting oil at a sort of a lower rate. So I think that a lot of things that they've done, again, some of the long-term policies of Make in India, some of the structural reforms that sort of they went forward and continue to go forward in. Yes, we all may believe that some may be right, some may be wrong. The mode of implementation of policies is always bad. Okay, unfortunately, we don't do a very nice long-term planned, structural reforms. I think the regulators all believe that they should disrupt, and that's the only way that we can do it in the country. I think that we have developed very well as an economy, so I think that we also have moved far forward. So one hopes going forward that some of the regulatory moves that happen are more systematic and gives people time to adjust and stuff. But I think all of this put together on the economy side, again, the good part is we didn't go overboard like some of the other countries went on the COVID time. I think they did a lot of good PR. Okay, the numbers look like some large numbers, but in reality, the funding from the government was relatively low. Okay, and I believe that's a right thing, because if you go and suddenly spend money, okay, you then face the consequences later. So US is facing the consequence of inflation right now because of the excessive spending that they have seen, and the writing was in the wall, right? So that is something that I've liked the government doing long-term things on, I think, and it's been very good. In the past, when I met a very senior person and in the industry, he came back and said, "My only fear, Anil, is that we've always made self goals." Okay, so I just hope there are no self goals that we make from here. Okay, because 2008 also was a great opportunity for us because we didn't have subprime, but we honestly got stuck, and the whole decade was a nightmare. So I'm just saying that I'm positive, and I think it'll also reflect and the steps that are being taken are good long-term steps.
Thank you, sir. The next question is: will Nifty make new low from now?
My preferred view is yes, but first it may even make a high. Okay. So that's sometimes a lot of the time. There's a previous quote there. You lose more money in anticipation. Okay, of, let's say, a correction, etc., and you lose out, everything. So that is something which sort of one believes. We may see a lower low. Okay, and like I said, the good part is I don't expect the lower low to be like it was, for the US. I also, the other good news is I believe that it's going to be a short one, and within 6 months, even if there's a period of volatility.
Thank you, sir. The next query is: why our manufacturing sector is not picking up? What is the reason? Please highlight.
Sorry, I was not able to hear you well.
Why our manufacturing sector is not picking up? What is the reason? Please highlight.
Yeah. So actually, if I look at the Nifty and the data, right, manufacturing is doing very well. Right. So at times it's about perceptions that we have and people that we talk to. Right. So sometimes in our own circle of influence, we may find that a guy who's in manufacturing is struggling. Okay. Now, what has happened is, yes, there's been a shift in places of growth, right? Like you saw during COVID, online retail did very well. Okay, but the stores, the physical retail did very poor, right? So similarly, I'm saying that even with companies, the new emerging leaders which are coming, and the whole competition that is coming, right, so the leaders are doing extremely well. Okay, and the ones who are proactive, able to move with times, do the right strategic moves, etc., they're doing extremely well. Okay, so that is something which so I still believe that it's not that it is too bad. In fact, I feel it will continue to get better, and from what one is seeing, even small businesses slowly are beginning to start doing well, including on the manufacturing side.
Thank you, sir. We can take one or two more questions if you allow me.
Yeah, so we can close another 2-3 minutes.
Sure, sir. So the next question is: what do you think, and as a beginner, we should start investing or wait for
I think we should start investing. Okay. And do phased investments. Okay, so I would think part of it you can do a smaller a bit of a lump sum right now because markets I think have sort of bottomed out. Okay, but do a phased investments and keep some money for what if market goes lower than the recent flows that we saw.
Thank you, sir. So let us take this last question and then we divide up. Credit growth is not visible. People are finding difficulty to get the facilities from the banks. The policies are not conducive.
Yeah, so I think that was true a lot in the previous decade. From what I'm seeing now, credit growth is slowly beginning to pick up, and data is also showing that. So if you look at the RBI data of credit growth, that has started picking up, and I would think that going forward it will become a lot more easy because banks and all will actually want to lend money more, okay, from their financial perspective. So you may find money coming a lot more easier, and I think that will also sort of get the economy to do well. We don't have the issues of the past of like NPAs and stuff like that. So today, so from that standpoint, banks are in a frame of mind also to lend. Okay, so I think that credit growth has picked up and is likely to continue to pick up as well.